Welcome to Tradeology and your bonus training. Today we're extremely privileged to have one of our associates share some of his wisdom and trading experiences. Make sure you watch all the way to the end because I have a very special surprise for you. It's something you'll only see once, and I promise it will be well worth your while to watch all the way to the end. Ready? Here we go.
All right, chart patterns. What I will cover here are some of my favorite chart patterns that will deliver a higher than average probability of a successful trade. Now, these patterns are reliable and many traders watch for these. Now, again, just like we had mentioned earlier, they don't watch for all of them necessarily. A lot of traders will watch for a specific chart pattern. And if you're having troubles identifying several of them, and there is one that you do recognize, then that's the one that you want to kind of put the weight into. Now, because of the number of traders waiting to trade these patterns, they do have a kind of self-fulfilling prophecy thing going on. They're more likely to work out simply because the big money trades trade them too. The big money traders, these guys are looking for, like I said, funds in particular are looking for double tops, double bottoms, and they're looking for head and shoulders formations. Now, when you put big money behind a formation like that, it tends to naturally work out simply because when you have a head and shoulders, there's a lot of selling pressure at a certain level. When you have an inverted head and shoulders, there's a lot of buying pressure at a certain level. And when that happens, when you get the big funds dumping a whole bunch of money into a chart pattern, they will tend to move. Now, these patterns are important because when you see these patterns develop, you will have a better idea which way the market will move as a result of the pattern. Now, there are trend following patterns or continuation patterns, and there are counter trend or reversal patterns, and there are neutral patterns in which the market can break out in either direction. Now, when I say there's continuation patterns, we'll have a trend moving upwards, and this pattern will appear. There becomes a 70% chance that that breakout of the pattern will move up. Maybe we will continue with the trending direction. A reversal pattern, like the wedge, for example, head and shoulders as well, are reversal patterns. So if the market has been moving up and then we see a wedge or head and shoulders, then the price as a result of that will likely move down. Now, there's neutral patterns as well, which can occur. And from there, there's no real bias to that. You know, with the continuation reversals, we have a bias to it. We're expecting the price to break out in one direction over another. But with a neutral pattern, that's not really the case. It could go either way. And when it does, though, it will generally move quite well. So, trend following patterns. We'll be looking at a pennant, a flag, and a rectangle. Trend reversal patterns, we'll be looking at the wedge, the head and shoulders, and double tops and double bottoms. And for neutral patterns, we're going to be looking at symmetrical triangles, ascending, descending triangles, and rectangles. Now, those of you that are familiar with these patterns, you're going to tell me right away that ascending and descending triangles are continuation patterns. And with the amount of trading that I've done, I have found that this is not the case. Ascending and descending triangles, we are going to look at these, don't have a bias. The setup is there, but the bias isn't as they say. This is a formation that fits in a neutral because it can break out either way. And I'd hate for a pattern to show up, an ascending or descending triangle to show up. You're looking for a breakout in a certain direction and it doesn't happen and you miss the trade. So if we can put that in a neutral patterns description, which I think is much, much more appropriate for this formation, then we're less likely to miss out on the action. All right, so we're going to take a look at the continuation patterns now. The following chart patterns are patterns you will find in a trend when the market is moving in a certain way. So as the market takes a break from the big moves and rests a bit, you will find one of these patterns emerge. Now, this whole resting is sort of that equilibrium concept. We're going to find that the market pauses, returns to equilibrium, and often at these equilibrium points, we're going to find a pattern. Now, they are a good indication that the market hasn't finished its trend, and the next trade you should be looking at will be with the recent trend direction. All right, so we're going to take a look at poles. Continuation patterns almost always have a pole attached to them. They're part of the continuation pattern. This means that prior to the pattern, the market leading up to it will have moved into the pattern from above or below. And usually it will do it with a fairly aggressive tone. The market was clearly trending in one direction, and the pattern that follows is a resting phase of that market before it carries on its way. Now, the pole is what we've got here in between the green and the red lines is the pattern itself. And we have a market that moves quite aggressively at times into the pattern. So it comes from below, and it's a fairly strong move, and it will move up, and then we'll get range bound. This is a rectangle, what we have here, just a range-bound market. But before we get into the range-bound market, the market moves into that range fairly aggressively. There is no question that the market came from somewhere to get there. So this one comes from below to get into the range. The picture next to it comes from above to get into the range. It doesn't kind of meander into it from the side, which some patterns do. But when we're looking at continuation patterns, there's often that move into the pattern, which is referred to as the pole. All right, so we're going to take a look at pennants. This is the pattern. So we've got an image of a bearish pennant and an image of a bullish pennant. Now, when you look at the terms bearish and bullish, this is where the market's going to move as a result of the pennant or a result of the formation. So if we have a bearish pennant, that means that there's a 70% chance that the market will move down as a result of this particular formation. A bullish pennant, the market will move up as a result of that particular formation. This one starts. We know that this one is bearish because of where it came from. It has a pole that moves down into the formation. And then once that's the case, once we get that market moving down and then that sideways narrowing range, we expect the market to continue moving down because that's where it came from. And the same goes with the market that's moving up. It moves up, gets caught in the range. There is a strong likelihood that it will continue to move up. So as the market is pausing, you will find price retracing into a narrower and narrower configuration. The market squeezes itself from both the top and the bottom, and the pennant shows up just before the market takes off in its original direction. Making this a pennant, you will find that the market leading into the formation creates a pole. A strong move that leads into the pattern itself. Again, the market comes down, gets stuck. Market goes up, and then it gets stuck. Now, what's the feature? The feature for a pennant is we start with a wide market range that gets narrower and narrower. And if you draw a trend line across the top and a trend line across the bottom, the trend lines would eventually come together. They would connect. But the trend line across the top slopes down. The trend line across the bottom slopes up. And this could be a pennant in a market. So we've got the market very distinctly moving down. It comes from above and it moves down. And now it gets stuck in this range as the highs and lows are getting narrower and narrower. If I draw a trend line across the highs, if I draw a trend line across the lows, they are getting squished. They are becoming narrower and narrower. And as a result, we are eventually going to have to break out of that. So we have this market move. It comes from above, it gets squeezed, and then from the breakout that happens, it tends to move downwards. Now you're going to find that the breakout of a pennant formation like this is going to generally happen at equilibrium. Right? This is a bullish pennant. Market moves from below, very strong, aggressive move, and then it gets stuck. And if I connect some of the lows, I could draw an upward trend line. If I connect some of the highs, I can draw a downward trend line, and the price does break out and it continues its market move, its trending direction. When we have a pennant formation, the highest high and the lowest low is going to be a certain width of that formation. We're looking at the widest part of that formation. And if I can connect this high and this low, I would extrapolate that to the breakout. So wherever it breaks out, if I'm looking at say a 30 pip range in here, wherever that price breaks out, the market can potentially move 30 pips away. Now that is the essential target for a formation like this. Whatever that widest mouth is what the movement will be as well. A lot of the times these formations will happen at equilibrium. So the target, that wide range, is going to be either the inner or the outer channel wall. So this is a bullish pennant formation. Take a look at a flag. This is the next one. So we've got a bearish flag and a bull flag. Again, these ones have poles. We've got a market that moves into this formation. And what a flag is a range-bound sideways market that is moving slightly against the trending direction. If the market moves down, we're going to find that it kind of wobbles its way upwards. Very shallow. It's not aggressive. It's not going to be a long period of time, but it's going to kind of reset itself by wobbling its way in the opposite direction. And then once it's recovered, then it will continue to move in the direction of the trend. Same thing with the bull flag. It comes from below, moves up. It's bullish because of a continuation pattern. Market is moving in a bull direction upwards. It moves up quite aggressively, gets caught in this receding range, will eventually break out and generally move in the direction that it was initially going. If I draw a trend line across the top and a trend line across the bottom, they will be the same, at the same angle. If I extrapolate these trend lines out into the future, they won't usually touch each other. They won't come together. They are parallel lines, and the market is caught within essentially a channel. So flag pattern is a take a break pattern as well. Now it starts off generally with a large quick move forming a fairly steep pole. Next comes the flag formation as it gently moves up and down slightly against the direction of the initial move. So if it's a strong initial upwards move, we'll have a wobbly moving down. Now, to be a true flag, the formation takes place between two equally separated lines, small support and resistance channel. Now, the bear flag is formed as a slightly rising formation, while a bull flag is a slightly falling formation. Again, there's the flag formations. After a break from a larger move, the market will resume its trend and continue on in the original direction. If you can imagine this, now let's actually take a look at an image. What we've got here is a chart. Price moves down quite aggressively, and then it kind of wobbles its way back and forth. Now, this can look like congestion or consolidation, and it is. I mean, that's what it is. We're looking at an area where the market has consolidated a little bit, but there is generally a high and a low to it. We can mark off the range that it's caught inside. Once we can identify that range, then a breakout of that range will have the market continuing to move in the direction it was originally moving. Now, you've heard me say the market's going to keep doing what it does until it stops. This is true. And this is an instance where we have a very quick identification as to when it stops doing that thing that it's doing. Right now, if I'm looking at a market like this, I don't really want to trade this because it's looking stuck. It's a little bit choppy. It's consolidated. It's clustered. But what happens is when I can mark off the highs and the lows like this, I've got a channel and then I can identify the channel that it's in. Once it closes outside of that channel, especially in the direction it was originally moving, then that's a really good heads up to the fact that it's stopping what it's doing. And this is a bull flag. So we've got the bullish flag formation. Market has moved up and it retreats in the opposite direction. It's not going to be a huge move in the opposite direction. It's more of a pause. So we've got a big move up. The candles are quite a bit longer. And in the flag, the candles will generally be a little bit smaller and they'll be congested a little bit. They'll be closer together. We'll find that there's just not a whole lot of movement in it. Finally, we do get a breakout to the top side because the pole is upwards. The breakout also is up, and then the market shoots off in that upward original trending direction. This is going to work about 70% of the time. All right, so the next one is a rectangle. Exact same thing with a rectangle. We have a pole, market comes down and wobbles its way sideways. Bull rectangle, market goes up and wobbles its way sideways. Now, the rectangles and the flags are quite similar in the fact that they are range-bound market conditions. We're going to find that the market does get trapped between a high and a low that we can mark off with, in this case, a horizontal level. These two lines will not touch each other. They will be marked off as parallel lines, but be moving horizontally. When we're looking at smaller time frames, we're going to often find this to be the case in off sessions. If we're looking at 15 minutes or 5 minutes, we're going to find if we're trading the US dollar, Canadian dollar, for example, that these rectangles will start to show up in the Asian session. Now, these kinds of things. We're going to find rectangles showing up in maybe the US dollar pairs after London closes. The last half of the New York session where the market is just starting to lose whatever momentum or volatility that it originally had. So a rectangle is a fancy term for a range, and it really is. It's a range-bound market. Now, a rectangle is a price action that you can sandwich between two horizontal lines, support and resistance levels. You'll find this after a big move, but also after the major market participants go to sleep on a smaller time frame. Rectangles are periods of equilibrium, and others say it's a period of indecision. Either way, it's a pause in the market that has a clearly defined high and low range to it. So a rectangle can be very narrow, as in consolidated markets, or a little bit wider where there is actual price movement inside of it. This is the classic formation of a breakout type of trade. These rectangles, these ranges, are really the ultimate breakout trade. We're looking for a sideways section of the market because we know that the market can't continue to move sideways. The whole point of trading is to not have that. We need to have the market moving in one direction to make money from it, or even lose money, but we got to have that movement. And when the market gets stuck going sideways, it is not going to be for a very long time. The nature of the market is to move. So when we can identify a sideways range-bound market, we really do have that heads up to an upcoming market move. We're going to get a market that moves sideways. We're going to get close to equilibrium. And then from there, we're looking for a breakout, generally in the trending direction. If the market has moved downwards, got stuck going sideways, it will 70% of the time break out to the downside. If the market has moved upwards, got stuck going sideways, it will usually break out to the upside. Now, again, I'm using these numbers 70% because that's what the industry has kind of stated. And I agree with them. I think they're pretty accurate. So if we are looking for a market that is doing this, if we've identified that we've got this stuck sideways patch, we don't want to be trading inside of it. Actually, let's go to a chart here. We've got an image here. So the market has moved down and now it's stuck in a sideways range. And then it breaks out of that range. And now the market continues to move down. What I want is for this information to help also determine when you shouldn't be trading. If you find that the market is range bound, and I do find that traders get caught in this. If the market is range bound and it starts to move sideways, that I'm not interested. And I've posted images in the chart of markets that I'm not interested in trading because of that. I'm in a market that I've identified as going sideways. And like I said, the market is going to keep doing that until it stops doing that. So if I'm looking to get into a trade when the market is moving sideways, I have to assume that it's going to keep doing that. Now, if I take a trade while we're inside the range, well, we could get to the top and we could get to the bottom of the range. And if that's your goal, if that's your target, then that's awesome and perfect. I mean, there's nothing wrong with that. But if I'm looking at a narrow range like this, and sometimes the ranges can be very narrow, they can be 5, 6, 7, 8 pips. There was one on, I think it was US dollar, Canadian dollar in the forum the other day that had a 15 pip range. Now that's not as small as the ranges I've seen, but it's not really a big range. It's not something that we're going to get a lot of movement out of. So if we're in a range like this, I have to assume the market's going to bounce off the tops and the bottoms until it stops doing that. And when we get a breakout of that range, and when I say a breakout or a move past or something like that, I'll refer to the movement past a line like this. It's not a spike that I'm looking for. I'm looking for the candle to actually close on the outside of that range. So I've got this rectangle formation, this gray candle that's circled here. This one closes below. Now that one kind of sets in motion that whole set of rules here. Once the market has stopped doing the thing that it's doing, so it's no longer stuck in that range, it has broken down below, closed outside. And if I get a nice aggressive close, that's even better. If I get a close that is absolutely no question that that's what the market looks like it's trying to do, if it's really trying to break out of that range, then I'm happy. You know, sometimes it's going to be a fake out. Sometimes we're going to get a close below and then it'll pop right back into the range. That happens, but most of the time, once we get the close outside the range, the market will continue to move. Now, with a range-bound market like this, generally the targets are going to be whatever the width of the range is. So let's say this range is 10 pips. We get a breakout. What's 10 pips below that range? That would be generally the target. Now, with us, we're using middle and outer channels generally for targets. But this is what this is. We're looking for a range. Now that I'm mentioning these targets, what I should probably do is go back to the manual version anyways and add one extra slide to each of these to show what the targets would essentially be. And I think that's exactly what I'm going to do. So this becomes a range in an upward moving market. We've got generally 2 points of contact. You can have more, 3, 4, 5 is better. But if you have 2 points, you get a double top basically, which establishes a high point. You've got 1, 2, 3, 4 points on the bottom here, establishing a very strong low point. We'll connect those. And if we are inside of that, I don't have much interest in trading. Now we take a look at the pole here. We get this market movement that goes up and then we get range bound. And I can see the candle sizes leading into this pole. I mean, this one candle is the whole size of the range. This candle here is like 1.5. This candle is 1.5. And even prior to that, we've got these bigger candles. So I know the market can move. And what happens is we get stuck in a range and the range is quite narrow. It's not even as big as some of these bigger candles. So I'm not interested in taking a trade inside of an area that can only get to a top and a bottom that's smaller than one candle that had happened previously. I want for the market to break out of it. We get a breakout on this little white candle. It's got a little white body, but a bigger lower wick. And then once that breakout happens, the market does continue to move. Now it does pull back into the range, but it ends up moving in the trending direction. Again, the target for this, you'd have the entry as it closes above. You'd have the stop as it's underneath the bottom. And then you'd have the 1-to-1. That will be your target on this. Now, if I were to draw a 34 inner channel, we'd see that the inner channel gets to this area in the market. We are going to find that these will start outside of equilibrium and then end up moving into equilibrium and then breaking out from there. Now, this brings up a point that I want to cover here really quick. This one candle formation, because it has popped up in the forum before. We've got a wick here that does pop out of the range. Now, that wick is not a signal, and that wick at the time being is not a reason for me to change my range width yet. What I want to see is what happens over the next couple candles. I get a breakout and then a pull back in. Now the next candle, the one that follows the push out, closes outside. So we're good to go. I'm happy with that. I would maybe readjust these trend lines if that push out resulted in a market move downwards. Maybe I got 2 or 3 more candles that moved away. Then I know that that actually found a top. If we are poking through like this, it hasn't quite found a top yet. A top would mean that there's a movement towards a bottom. And this isn't the case. We don't have that movement towards any kind of bottom. We had a top, it poked out, but the market just kept going. So that would be fine. If I get a couple of wicks followed immediately by an actual signal, we're cool. We can take that. We don't have to make any adjustments. If I get a couple of wicks, but the market is affected at a new level, gets turned down, then I might want to consider redrawing my lines.
How good was that? Now, because you're a Trade Predator customer, because you've shown that you're serious, I'd like to make you a very special deal. This is the only time you'll see this, so please pay attention. Normally, the automated version of Trade Predator sells for $97. Remember, the automated Trade Predator does the following. When it sees a trade you should take, it alerts you both visually and audibly. The yes and no buttons then appear automatically. A quick glance and a simple push of a button is all you need to be in what could be a highly profitable trade. I'm going to show you how to get it for free. Just keep watching. Here at Tradeology, we've trained over 5,000 ordinary people how to trade the Forex market. And even though there's nothing wrong with the Trade Predator, we know that the surest way to success is to be properly trained. That's why I'd like you to consider getting a copy of our flagship training, Secret of Trading. And I don't use the term secret lightly. The system that I'm about to show you disappeared off the face of the earth for a couple of years after winning the largest independent Forex trading competition on earth. It was available only once a couple of years ago and for only 2 days before selling out. It was $1,000 at that time, and I remember kicking myself many times for not getting it then. It's never been seen again since. The astonishing conclusion: it's so straightforward, so simple to understand, and the rules are so exact and easy to follow. I want to prove to you that you could do the same by letting you test drive it for 60 days at no risk to you whatsoever. I'll tell you more about that in a minute. This system uses a unique combination of indicators in a way that produces so many good signals that there are always plenty of profitable trades, even if you have little time to trade. So even if you can only trade a few minutes a day, you'll see more success than you could trading for hours upon hours any other way. This system is so profitable, yet so simple to learn and trade, that it's revolutionized how people trade. But it gets even better. As we were testing this system, it just seemed to work for everyone we gave it to, from beginners to highly experienced full-time traders. Team tester David said, "Everyone on the testing team's jaws are on the floor. We thought this baby was lost forever. Now with the addition of the latest technology, we are all in agreement that you just may have found the holy grail of trading." Team tester Mark said, "I've been looking for this system for 2 years. Everyone thought this jewel was lost and gone forever. Way to go, man. We love you for this." It gets even better, though. We realized we should offer far more than just the system to our valued clients such as you. We thought, what if we could teach you the secrets of some of the most successful and richest traders on earth along with the system? What if you could learn how the elite 1% of traders make 99% of all the money in Forex? What if you could master everything you need to know to start making mountains of money in just a day or two? How would that change your life? Let me ask you this. Are you ready to take the final step to financial freedom, to actually get your hands on the kind of system and information it takes to make money trading Forex? Can you spend 30 minutes a day learning the secrets that have created Forex billionaires? Do you want a system that tripled an account in 30 days? I'm not saying that will happen. It probably won't for most everyone. That's because they won't do anything with what you're about to learn. But if you do, it could change your life. So this isn't for everyone. If you just want to make some money with no real effort, then you have everything you need already to do that. On the other hand, you want to get wealthy, and I mean really wealthy, then this is definitely for you, so pay attention. Here's a simple 3-step process to making your financial dreams come true. 1. Get the only system I know of to ever triple an account in just 30 days. The very same system that beat out over 3,500 others to win the biggest independent, totally transparent, most respected trading competition in the world with a 316.54% 1-month gain. That's a value of $1,000. 2. Then we give you your very own copy of the automated version of the winning system, a value of $497. 3. Next, we teach you the secrets learned from a decade of working with some of the most successful traders on the planet. These are things the average trader will never know. You'll have access to a private members area filled with resources and training reserved strictly for this elite group. And we'll invite you to weekly webinars where you can go over your trading in a group and on a one-to-one basis. You basically have access to a professional trader 24/7. This alone is priceless. You will not find this level of commitment to your success anywhere else. A value of $997. If you're new to trading or you just want to learn more, we have some of the best grounding fast start materials in the industry. We get people up and running faster than they ever thought possible. And you can call in at any time and have someone talk with you and work through anything you're having difficulty with. A value of $497. Here's how it breaks down. The Secret of Trading system that made 316.54% in a month, a $1,000 value. Trade and Money Management Interface, a $497 value. Private access to the members area and weekly webinars, a $997 value. Fast Start Grounding Materials, a $497 value. We could easily charge $2,991, and that would be a deal. The system alone was once made available to an exclusive group for just 48 hours at the price of $1,000. Sold out and then was immediately taken off the market. Without the new groundbreaking automation, that makes it even more profitable and much easier to trade. But you won't pay $2,991 or even $1,000. You won't even pay $500. Because you've trusted us and shown us that you're serious by buying Forex Trade Predator, you can have this account tripling system and all the training for just $297. And here's what should make this a no-brainer for you. You get the automated Trade Predator for free, a value of $97. That's right. Not only will you get the best-selling Secret of Trading with an 89% discount, I'll also throw in the automated Trade Predator for free. No one else can get it at that price and with the automatic Trade Predator for free. This offer is not open to the general public. It's just for you. So please do not share this with anyone. I'll even assume 100% of the risk. Even at this massively discounted price, you risk nothing. Try it for 60 days, and if you don't think this is the best method of making money trading you've ever seen, then simply drop me an email for a full refund. No explanation necessary, and you owe nothing. Here's what I recommend you do. Try it. Test drive it for 60 days in a demo account. If you don't make money, let me know and I'll return every penny, no questions asked. That way, you haven't risked a dime. That's how confident I am that this can work for you. I know you won't do that, though, once you see how fast your account starts growing and keeps growing once you start trading the system. Hit the Add to Cart button on this page right now, and you could immediately be on your way to the lifestyle of a wealthy, independent trader. Free of the confines of living on a budget and going to work at a job every day. Isn't that what you really want? To be financially independent and have the money to do all the things you want in life? I have personally witnessed this triple an account in a month and then continue to get phenomenal results for everyone who has used it, myself included. This could be your ticket to the good life too. By accepting my offer today, you're making a decision, a commitment to yourself to join a very small and elite group who are determined to finally gain permanent and lasting financial independence. But you must take action right now if you want this deep discount. Just hit the Add to Cart button on this page to get started today. It's unlikely you'll ever have the opportunity to have a system and the training to go along with it of this caliber ever again. I've never seen its equal in all my years of trading. Saying yes to this today gives you an edge that could easily mean a fortune to you. Don't pass that up. Hit that Add to Cart button now.